Okay, I think we'll just make a start. So good evening and welcome to tonight's webinar, which is brought to you by the Farm Advisory Service. My name's George Gawley. You can't see me on the screen, that's probably a good thing. But I'm joined here tonight by Chloe McCulloch, who is an agribusiness consultant from SAC Consulting. Tonight we are going to focus on tax basics for new entrants to farming. Now, it's quite a big audience tonight, but we're going to try and make this as interactive as possible. On the right-hand side of your screen, you should be able to see that you are able to ask questions. Now, we might not have time to answer all of them, but we will leave some time at the end and we'll try to make sure we circulate a list of Q&As after the webinar. Tonight's webinar is also recorded, so you will have the opportunity to play it back if you would like to go over any of the content again. So why are we holding a webinar on tax basics? Well, it can be a very taxing and complicated subject, to say the least. And although tax advice relating to your business absolutely must come from your accountant, it can be hugely beneficial to understand a bit about the basics so that you get the most out of that conversation with the accountant and know exactly which questions to be asking, especially useful if you're starting up for the first time. So I'd like to go ahead and introduce Chloe, who is going to go ahead and start tonight's presentation.
Good evening, everybody. And as George says, thank you for joining us for this Farm Advisory Service webinar. I will switch my webcam off in a minute, but I know it can be better to be able to see who you're listening to, at least at the outset. What I'd like to do for the very kickoff, though, is if you could have a look, you should be able to ask questions. So there's a feature where you can ask a question or you can raise your hand. If you want to try and check that you can use the questions button, maybe you could tell us what you can see from your seat where you are now. It'll also give us the opportunity to be sure that everybody can hear us. I see a couple of raised hands. Oh, I see some questions coming in now. That's fantastic. Thank you. If anybody's struggling to ask questions, there's also a chat facility as well, but we'll see how we go. So thank you for joining us for this Farm Advisory Service webinar. As George says, I'm Chloe McCulloch. I'm an agricultural consultant, but I'm also a specialist business consultant with SAC. I often help new entrants with business plans and things, and I understand what areas commonly trip people up. As George said, this is not intended to replace the advice of your accountant, but it's intended to give you a much clearer idea of what you're going to ask the accountant and to make a bit more sense of what they're telling you. So it's mainly about tax, but we'll probably have a look at a few slightly peripheral things as well, but these are quite important to the understanding. So tonight we're going to have a look at business structures and responsibilities. We're going to have a look at tax, and in particular we'll look at tax years, financial or trading years, income tax, self-employed income. We'll have a wee look at what is involved in having a job and a business from a tax perspective. We'll have a quick look at machinery. We'll have a wee look at livestock as well. So the first thing that we're going to have a look at tonight is business structures. So if you're creating a new business, you have a choice about the structure that you're going to use. The types of business structures that we have are broadly sole traders. So that's when it's a single person who is involved in the business. You have partnerships, so where there's more than one person comprising the business. And sole traders and partnerships are by far the most common for a farming business. You also have limited companies. Limited companies are a little bit different. Instead of partners, they will have directors and shareholders. And in theory, you'll have public limited companies, but so these are companies where the public can buy shares and aren't seen in farming. Now, it's worth saying that limited companies do need to publish certain amounts of their accounting information, and there's a certain amount of information about the directors of the business that's available on Companies House website. Limited companies will be relatively unusual for farming businesses, but they do exist. But they're definitely something to go into on the specific advice of an accountant for very, very specific circumstances. By far, the majority of new businesses will still be sole traders or partnerships. It's important to think about the responsibilities that you have if you are involved in a business. So a sole trader is going to be personally liable for any debts of the business. So that means that if a sole trader's business runs into difficulty, then their personal assets, so for instance their house, their car, could be at risk. In a partnership, the partners are jointly and severally liable for any debts of the business, so their personal assets are at risk. And in a limited company, whilst in theory the liability is capped at the amount of their investment, the personal assets of the directors shouldn't be at risk. However, a director of a limited company has a responsibility not to allow the company to trade when it's insolvent or when it would become insolvent. So if they do that and the business subsequently goes under, then their personal assets may still be at risk. So it's really important to understand what your responsibilities are before either starting a business, but particularly if you are going to become a partner in an existing business or you're going to become a director of an existing business. To see how that would work in action, we're going to look at an example here. So Smith Farming Partnership is a family farming business and there are 4 partners. They have a bank loan of £580,000. The partners are Robert, who's got a 60% share in the business. He runs the business, so he's directly involved. Anne has a 30% share in the business. She runs the business as well, so she's heavily involved in the day-to-day. Fiona is their daughter. She has a 5% share and she is also involved in the day-to-day running of the business. And then finally, we've got the last 5% is Mark's share. He's their son, but he has nothing to do with the business. He lives and works in London and has no involvement in the day-to-day. He signs the accounts once a year and that's it. So I'm going to put up a poll in a moment and you should be able to answer through the poll. What proportion of the total business debt is Mark liable for? Is he liable for 100% of the debt, 25% of the debt, 5% of the debt, or none of the debt? So I'll put up the poll in a second, and if you have a think. Oh, hold on, I've closed it too quickly. Oh, drat it, it's closed too quickly. Have a think about what proportion Mark is liable for. We're going to come back to this one. We're going to come back to this one later. Bear with me a second. I'm going to get this to work because I don't want to give the game away if I come back to it later. Right, we're going, sorry about that. So if you can have a think about what proportion of the business debts Mark is liable for, and vote now, please. Five more seconds. The next time I do a webinar, I'm going to get a countdown clock, I think. Okay. So I'll let you see what the results were. Oh, that's really interesting. So the majority of you thought that Mark probably had a 5% liability. Presumably that's because that's what his share of the partnership is. And the next most popular answer was 25%. So by far and large, the vast majority of you acknowledged that he would have some liability, but that just under 80% of you thought that it was either 5% or 25%. Presumably that's because there are 4 partners. Would you be surprised to know that Mark actually has 100% potentially of the liability? So this is a really important point. Mark, even though he has nothing to do with the running of the business, is still technically liable for up to 100% of the debt, because all the partners in a partnership are jointly and severally liable for the debts in the business. In fact, potentially, if Mark has got more money and more assets than the other partners, perhaps he has more liquid assets, he has got money in the bank and so on, potentially in that case, Mark could in fact be a key target for the accountant in bankruptcy if things went wrong. And that's really commonly misunderstood. There are similar risks for what you might think of as minority directors who might not have any input into the running of the business, but where the law states, as I said earlier, the directors have a responsibility not to trade whenever the business is or would become insolvent. And if it's later discovered that a director did permit the business to trade when insolvent, then potentially their own assets can become at risk. The key message here is that if you are going to join a partnership, it's really important to understand that the moment you join that partnership, you are potentially liable for, an unlimited proportion of the debts of the partnership. And if you're going to be taken on as a director in the company, you do have responsibilities as a company director. And if things go wrong, not understanding your responsibilities is not a defence. Can everybody see the presentation screen again? Hopefully everybody can see the present. No.
There's a few people that can't, Chloe, and mine's gone white as well.
Right, okay. Let me try sharing the
that's it.
results.
That's it back. It's back now. It's got the poll results.
Poll results. Let me hide that again. Oh, hold on. I know what I need to do. Right, try that now.
Yeah, that's it. Back now. You just go back into the slideshow. That's it. Yeah.
Here we go. Yeah. We have done this before, folks. You might not think it. Okay. So think carefully before joining a partnership or a director in the business. The other thing to bear in mind is that there are implications for both parties when you join the partnership. So for instance, if a prospective partner has any history of credit problems, then it might be to the business's advantage not to bring them into the partnership, and certainly not before they're about to perhaps refinance or seek finance, because the inclusion in the partnership of somebody with a poor credit history could make it more difficult for the business to get finance, or it could make it more expensive. So on to tax then. What are some of the objectives of the current UK tax regime? What is the point of tax? I'm going to get you to do another poll, another question. So if you can check the relevant boxes that you think are the objectives of the tax system in the UK, I'll give you 5–10 seconds. Okay, lots of answers coming in. Right, I think we've got everybody. Here are the results. So the people who said all of the above are correct. So the tax system isn't just about generating income to spend on things, although it is very important. The tax is the regime of tax is used to encourage people to save. So, for instance, you'll get ISAs and personal savings allowances and things which are there to encourage people to save. They pay for things. They are trying to encourage you to smoke and drink less, hence the tax on cigarettes and alcohol. They are trying to encourage us to pollute less. You've got things like landfill tax, climate change levy, company car tax. So tax isn't just about raising funds, it's also about trying to change our behaviour to a certain extent. So all of the above. So then we come on to the types of tax. You'll have heard about income tax. Income tax is payable by individuals on their earnings, so for instance self-employment and employment income. But often people don't realise that income tax covers almost all income, so whether that's from savings, pensions, as well as income from work and self-employment. You've also got national insurance contributions, so they're slightly different. You pay national insurance contributions essentially so that you can qualify for a state pension and get certain benefits. We could have a whole session about national insurance, but I don't think this close to bedtime that would be a good idea. We can do that another day. Other types of tax would be capital gains tax. So capital gains tax is payable by individuals when they sell a capital asset. So if they sell some land, buildings, shares, antiques, it won't cover very small amounts, but I think that if you've got a gain of more than, I think it's £6,000, then potentially capital gains tax kicks in. And then we've got inheritance tax. So inheritance tax is payable by executors on the value of the estate of a deceased person. It's also payable if you get or give certain gifts during the individual's lifetime. So essentially what that means is it's not possible to give away all your assets just immediately before you die and hope that you'll avoid anybody having to pay inheritance tax. It's, again, that's something that you could spend an evening talking about, and it's not within the scope of what we're going to do this evening. So here's a question for you. There isn't a poll for this one. What do all of these have in common? Do you recognise them all? So we've got Rory Bremner, Paul Daniels, Mylene Klass, Meryl Haggard, and the tax year. So basically all of these have birthdays on the 6th of April. So the tax year begins on the 6th of April and it runs until the 5th of April. So many countries use a calendar year, but in the UK, I think Australia as well, do something a bit different. So we have a tax year and it runs from the 6th of April to the 5th of April. So whenever you are submitting your tax return, that will be your tax position as on the 5th of April. Financial or trading years are a little bit different. Relatively few people have a financial year that also ends on the 5th of April. So the financial year of the business is different. You can choose it to suit your business, ideally to mirror the natural cycle of your crop. So for that reason, the 31st of March and the 30th of November are very common, but you do also get 30th of April year ends, May year ends are quite common. You sometimes get December year ends, but the year end can be any date, something sensible for your business. So to look at an example, John is a suckler beef producer. He calves in February, March and April, and he sells his calves at weaning in October. So which is likely to be the best year end for John's business? Have a think. Which one do you think would suit a suckler producer who calves in February, March, April and sells at the end of October or in the middle of October? A few more seconds. Okay. So yeah, 30th of November would make sense for John. If he's selling all his calves in October and the calves are born in February, March, April, if he was to have a 31st of March year end, he would have some calves on the ground at the year end, but he'd have a lot of cows still to calve, and that would make it a bit more complicated to work out valuations of stock and things. The 1st of August wouldn't make much sense because he's going to have a calf crop nearly ready for sale, but not quite. He's probably going to be well suited with a 30th of November year end. A lot of the costs associated with these cows, you know, just before the calve and for the winter housing period, will be incurred within the same financial year that their calves are sold. The calves are born and sold all within the same financial year. So it will suit his business quite well to have at the 30th of November year end date.
Is that also quite useful for benchmarking, Chloe, in that you can sort of match up the fixed costs with the sales quite easily?
It certainly makes it a lot easier if you've got all the costs incurred in one year. It can be quite complicated where you're trying to perhaps work out what the cost of a particular calf crop is. So if you're participating in the QMS benchmarking scheme, you're trying to look at the costs for a whole calf crop. And if you've got a financial year that it straddles, it can be more complicated. But everyone will have a certain amount of compromise. So if John's a specialist suckler producer, and he's only got suckler cows, then November will suit him quite well. If he's also got an autumn calving herd, then November becomes maybe less clear cut. If he's also got a lot of sheep and he's lambing in the spring, you know, things might be different again. You know, when does he sell his lambs? So it's not normally just as straightforward as that, but you do need to have a think about when your majority crop is. A chat with your accountant and you'll be able to come up with something.
Yep.
So having identified that the tax year runs from the 6th of April to the 5th of April, your financial year or your trading year can run from any point in the year for a full year. The next thing to understand then is how do the tax and financial and trading years interact. So you'll want to know or have a sense of when you're likely to need to pay tax on certain income. For instance, if you have a particularly good farming year, you want to be able to understand at what point you are likely to actually have to pay that tax. When will that sort of filter through to a tax bill? So I've got a wee diagram here. So this point here is the 5th of April. Everything before the 5th of April 2019 is the tax year 1819. So this tax year started away back in 6th of April 18 and it runs up until 5th of April 19. And then over here, this bit here is the tax year 1920. So it started on the 5th of April and it will run up on, it started on the 6th of April and it will run up to the 5th of April 2020. We've got a business here who has got a year end of 28th of February 19. And the business has, with the 28th of February 19, their 28th 28th of February 19 is included in their tax year to the 5th of April 2019. So the year-end 19 farm profits are considered in the 18-19 tax year. A business who has got a financial year which is only a couple of months later, it only finishes a couple of months later, this business with an end of April financial year finishes after the 5th of April 19, and it then is going to be included in the tax year 1920. Okay. So to give you an example of that, Mary has received her accounts for the year ended 31st of May 2019. So into which tax year will that income be counted? Will it be the tax year to the 5th of April 19, the 5th of April 20, or the 31st of December 19? Got another question for you here. What do you think? For the year ended, her accounts for the year ended 31st of May 19. And the responses are coming in. Five more seconds. A few more. Okay. So that Mary's year-end 31st of May 19 will be included in the tax year to the 5th of April 20. So the 91% there got it. The tax year to the 5th of April, because her year ended after the 5th of April. So coming back to income tax, theoretically, all your income from employment, savings, pensions, etc. needs to be declared. So employment, property income, investment income, savings income, so interest that you earn, pension income, and income from business profits. But there are a few get-outs which mean that everybody doesn't end up having to do a tax return. You know, somebody who earns £4.25 in interest on their, savings account, who doesn't have a business, wouldn't otherwise need to do a tax return. They're not going to have to do a tax return. So you can earn up to, I think it's £10,000 from savings or investment income before that would trigger you to need to submit a tax return. There's also a minimum threshold for property income, though it's a little bit more complicated as to what you can deduct for that, but I think it's about £2,500 after you've deducted the expenses of your property. But that's definitely one to speak to the accountant about, because property income has changed quite a bit recently. The HMRC, we talked at the outset, the HMRC, they use, or the government use tax to try and modify our behaviour. One of the ways that they are trying to modify our behaviour is reduce the attractiveness of being a buy-to-let landlord. So hence the tax advantages of being a landlord and renting out a property are not what they were. So who should complete a self-assessment tax return? Definitely if you're self-employed and you're earning more than £1,000, that would be pretty straightforward. If you're a partner in a business partnership, you would complete a tax return. So for a person, a self-employed person, you will submit a tax return, and all your sole trader income and expenditure is put onto your tax return. If a partnership is doing a tax return, the partnership will actually have their own tax return, and then each individual partner will declare their share of the business profits or losses on their individual tax return. So a partnership with 3 partners, there'll actually be 4 tax returns done, one for each of the partners and one for the partnership itself. You might need to complete a tax return if you need to pay capital gains tax. So even if you haven't started trading as a self-employed person, if you had say you had sold a development site or had some other sort of capital gain, you might need to submit a tax return. You might need to submit a tax return if you've got property rental income, you've got a buy-to-let or some other sort of rental. You might need to submit a tax return if you've got a certain amount of income from savings, investments, dividends, things like that. Although that's not quite as clear-cut, and you definitely need to ask the accountant whether you're above or below the threshold. And you might choose to submit a tax return if you want to either claim some income tax reliefs, or if you need to prove that you are a self-employed person. So I think there are some benefits where you may need to be able to demonstrate that you're self-employed, and a indicator of being self-employed is that you would submit a tax return. But the key thing is ask your accountant for advice. The tax return deadline is another pretty critical bit of information to know. Your tax return needs to be submitted by the 31st of January of the following year. So the tax returns that the accountants are all frantically trying to get finished before and submitted by the 31st of January this year are for the year ended 5th of April 19. The tax return for 1920, so for the year that we're in currently, the tax year that we're in currently, will need to be submitted by the 31st of January 2021. Now, you can submit a tax return anytime you like after the 5th of April, and in fact, once you're set up as a for self-assessment, you will get a letter from HMRC quite soon after the 5th of April reminding you that you can get on and get your tax return submitted. And if you're due a rebate, then they normally pay that fairly quickly. So if the revenue is going to owe you some money when you submit your tax return, there's no reason to wait till January. You want to crack on and do it. If you owe HMRC money, even if you're leaving your tax return a bit later, you have to have the tax paid by 31st of January. So you can't submit your tax return at the end of January and then get a bit of grace before you actually pay them. You want everything in by the 31st of January.
So how do you actually go about submitting a tax return, Chloe? Do you speak to your accountant and sort of hand them a folder of receipts, or how do you actually go about it?
That's basically it. Yep. So you'll speak to your accountant in plenty of time. The ideal time to be speaking to your accountant is just after your financial year ends. You will take them in your books. So for some people, that particularly smaller businesses, that will still be potentially paper books. Businesses who are over the VAT registration threshold of £85,000 now have to do Making Tax Digital. So those businesses will be using a cloud-based bookkeeping program on a computer. And depending on how the extent to which they take up some of the features on the cloud-based system, they might not have paper books to go in. The information might be online. They might have taken photographs and uploaded all the information onto their bookkeeping system. But basically, you give the accountant all the information and they will do that for you. It's a really good idea, though, to go and see your accountant before the end of your financial year, not necessarily after the financial year. It would be quite common for people to go and sit with the accountant once the books have been produced. So they've got to the end of the financial year, they put the books in, the accountant has produced the accounts and then invites them in to sit and have a conversation about it. It can be interesting to have that conversation. And it can give you the opportunity to go through with the accountant and make sure that there's nothing incorrect. You maybe have a conversation about something and they say, oh, well, was this private? You say, no, I know it looks private, it was actually a business expense, this is why. And they say, all right, that's fine, we'll put it back in as business expense. So it can be a valuable conversation. But if at that point they say, well, you've made quite a good profit this year, it's too late to do anything about it. If you'd known that you were maybe going to make a profit 3 months before the end of the year, you could have had a hard think about, well, when am I going to replace that piece of machinery? Should I do it this year, or should I wait 6 months and do it next year? Better still, maybe I'll just order a bit more lime, or maybe I'll just, bring forward some repairs or some improvements I was going to do, so that you don't have such a big profit at the end of the year.
Yeah, so your accountant shouldn't be somebody that you're afraid of. It should be somebody that you're proactively engaged with.
Yeah, you want to work with the accountant. All businesses eventually, and I would think that this will be in the 5-year time scale probably, the government are pushing towards making all tax digital. So at the moment they've started with VAT, but only for businesses above the VAT threshold. So not everybody has been caught by that. But they're going to roll making tax digital for VAT out to all VAT registered businesses, regardless of size, soon. And where they want to get to is that even income tax is done digitally, so that instead of you submitting a single tax return at the end of the financial year, at the end of the tax year, you will submit quarterly returns to HMRC, where you're giving them information on a little and often basis as you go through the year. And what you would have traditionally done at the end of the year when you did your tax return, they'll call quarter 5, and that's just a wee tidying up and adjustment. So that will really push you to having to have a really good relationship with your accountant, because you'll have to speak regularly, quarterly, so that whenever the kind of adjustments that might get made in your books at the end of the year may well have to be made on a quarterly basis in future.
Okay.
Okay, so it's gone to sleep. That's a week. Okay, so you have a number of different types of income that would go on your tax return, but we'll turn our attention now to self-employed income. We all have an idea of how that goes. You go along to the accountant and give them the information, and they produce accounts that show, your income less your expenses, and that provides your profit figure. So the question is the profit figure at the bottom of your accounts, and we'll assume that these are the finalised accounts, you've been to see the accountant, you've confirmed that you're happy with everything, is this finalised profit figure at the bottom of the accounts the figure that is effectively used as self-employed income on your tax return? Should the income on your tax return match the profit at the bottom of your accounts? Yes or no? Have a wee think. Oh, this is a close one. That's what we like. Couple more coming in, a few more seconds. Last one. Okay. How's that for close?
Very.
Okay, so 47% thought that yes, it should, and 53% thought no, it shouldn't. Okay. No, the no's have it in that case. The profit at the bottom of your accounts is not the same thing as the taxable profit that goes on your tax return, and that is a really common misconception. And I think it would be fair to say that a lot of people, regardless of the size of the business or how long they've been trading, a lot of people don't know this, because although they look at their year-end accounts, probably, hopefully, almost nobody actually looks through the tax return that the accountant sends them at the end of the year. So even people who have been trading for a long time can be oblivious of this, because they've just never looked and noticed that they are quite different. So to understand why, you need to think about why accounts are produced. So basically your accounts are produced to a standard that is set down by the accounting bodies across the world. The idea is that your business can be compared with one anywhere else in the world. And it might not seem so relevant for a farming business, but generally in business and industry, it's really important that investors and other people who might have an interest, like your bank, understand the rules by which your accounts have been produced. So the tax system is quite variable and flexible. Government decides they want to change something, and therefore what goes into your tax return might be different, but your accounts have to be prepared to a consistent set of standard accounting conventions. So it's really important that this consistent approach is taken to the accounts. So that's why your accounts will look like the way your accounts look like, and the same convention will have been used for everybody's accounts, but your tax return will look different because there's more current information going into that. A common one would be depreciation. So this is one of the areas where they tend to differ. In your accounts, the value of your vehicles, plant and machinery will be depreciated each year. A little bit is taken off, which is considered to account for the decrease in value of these assets year on year. You might depreciate the assets in your account at 20%, but in actual fact, in tax terms, you might get a 100% relief on the cost of the new asset when you buy it with an annual investment allowance, or you might only get an 18% writing down allowance, which is an amount that they will allow you to take off your taxable profit to reflect the value of some other assets that you have. So your depreciation in your accounts will be added back to your business profit for tax purposes, but then a separate different amount will be taken off to account for your machinery costs. So what if I have a business and a job? That's quite a common scenario, particularly with new entrants. Your tax return is going to bring together all the sources of income that need to be considered. So employment income, self-employed income, property income, etc. The example I'm going to show you here excludes savings income and things. It just assumes there's only employment income and self-employed income. Your tax return will then consider the various allowances that you're due. So we've got income here, we've got variance allowances. In this case, we've got £12,500, which is the personal allowance, but some people might be, if there was savings income included up here, there might be allowances relating to savings income. So it works out what's your total income, what can be taken off that for the various allowances, how much tax is then due, and then how much have you already paid through PAYE, and how much tax is therefore due to be paid separately to HMRC. Potentially, if you have a big capital allowance to use, so if the annual investment allowance for machinery means that if you were to go and buy, say you went and bought a new livestock trailer for £4,000, the annual investment allowance means that you're able to deduct the full £4,000 from your taxable profits, and the tax that you're due to pay is based on your profit less the £4,000. Potentially, if there's a big capital allowance, it might actually mean that there's a negative amount of tax due. So that recognises that your business was profitable, but that you have made capital investments of a particular amount. Those are going to be knocked off that, and that leaves a negative amount of tax due. So that's a tax rebate. It's particularly important, vital, to get really good tax advice if you work off farm as well as having the business, because what's at stake isn't just whether you'll need to pay tax on the business profits, but potentially whether there's the possibility of a rebate based on the PAYE that you have already paid. So it's really, really important that if you've got a job off farm and you've got the farm business, you get good tax advice.
So Chloe, if somebody is a partner in a business, is it a similar model as to how it's worked out?
Yeah, It's the very same. So if you were a partner in a business and you've also got a job, your tax return will show your employment income, and then in here in the self-employed taxable profit, it will show your share of the partnership profit or the partnership loss.
Yeah.
Whichever it may be, then you'll get your allowances and things off that. So the self-employed taxable profit, I think the annual investment allowance will be taken off the taxable profit figure up here. It's not really an allowance down here. So if you're in a partnership, you've made the partnership's made quite a big investment in equipment for the year. The self-employed taxable profit, your share of that might actually be a minus figure up here, even though the business is in profit.
Yeah, yeah.
So speaking of machinery and tax, the annual investment allowance, I mentioned this earlier, this basically means that you can deduct the full value of the qualifying item from your profits before tax. And it includes most plant and machinery, but it doesn't really include cars, or certainly the rules around cars and the rates around cars are completely different. So really it's meaning commercial plant and machinery. It doesn't include buildings and it doesn't include land, but it might include some of the fittings inside buildings. So it probably doesn't include the doors in your buildings, but it might include an automatic watering system, for instance. So it is worth making sure your accountant is aware of any proposed investment in buildings or infrastructure, because there might be elements of that where you would get the investment allowance. Generally speaking, if you make a capital investment in the business, so say for instance you build a shed, that you're not allowed to deduct the cost of that shed that you've built from your taxable profits. If you were to repair a shed or make repairs to a shed, then those are business expenses. But the building of a shed or the cost of building the shed in the first place, that's not a deductible expense. Therefore, it becomes quite important to see if there's anything in the shed that could be a deductible expense, and things like automatic watering systems, anything which is potentially even electrical systems, things like that, anything which would be internal fixtures. So the government likes it when businesses invest in equipment because it creates jobs and it keeps the economy going. So to encourage this investment, they have this annual investment allowance. It will be of particular interest to those who pay as you earn. So for instance, if your business makes a profit of £3,000 and you already pay income tax on employment income, it becomes really important to be able to knock off the value of any capital purchase that you've made for machinery. So if your business makes a profit of £3,000, you're already paying tax on employment income, but then you buy a piece of equipment for £10,000, then your business will show a taxable loss of £7,000 and potentially you'll get some tax back equating to that £7,000. These are the rates for the annual investment allowance. They've shifted about quite a lot. They do tend to change, but they're £1 million in the current year. They were down 50, 125,000 pounds 10 to 12 years ago. I can remember there being quite a bit of pressure on to get things like slurry storage tanks completed, above ground slurry storage tanks completed. There were grants on the go, and the risk was that if the grant application wasn't approved in time, it wasn't just that it held up the project, but it might mean that the bill for the slurry tower, wasn't being paid in the right financial year, and it could make the difference between, certainly the ones that straddled the sort of 2012, it could make the difference between being able to get the annual investment allowance and knock that value of the slurry tank off the tax bill or not. So in the past, it has been really, really important when they've started to shift these amounts around. But I think for most businesses at the moment, bearing in mind you can't use it for land or sheds, £1 million will be fine for new entrants. Now, this might seem a bit strange to be talking about livestock, and I'm aware that there's a couple of pictures of tractors up here. Other colours of tractor are available. These were just the first ones I came to. If you're a farmer and you buy a tractor, so this guy here buys a tractor, then the likelihood is that it's classed as part of your plant and machinery. It's a long-term asset in the business. Hopefully you get the annual investment allowance so that it reduces your tax liability, but it goes on your balance sheet as part of your plant and machinery. It's an asset that you're going to use in the business to operate the business. If, on the other hand, you are a tractor dealer, which is what this guy here is meant to represent, if you're a tractor dealer and you buy a tractor, then you're probably buying it as part of your trading assets. So it's not part of your plant and equipment to run your business. It's part of the things that you are going to buy and sell to run your business. So it would be a trading asset, and it would be a short-term asset. Livestock are no different. So you can elect whether to class your stock as trading stock or whether to class them on a herd basis. So a herd basis is essentially where the livestock that you have are treated as a long-term capital asset. A trading stock basis is where they are treated as a short-term trading asset. Now, your accountant would advise which would work best for your business, because there's pros and cons of each, and it's highly dependent on your individual circumstances. Definitely something to have a talk to the accountant about, and it's probably quite a good reason why you want to have an agricultural accountant.
Chloe, could you just maybe, I've got a question here. Could you just go over again what is allowed for the capital investment allowance? Is it just machinery, or does that include drainage improvement, fences, field shelters, that type of thing as well?
Okay, the annual investment allowance does not include most of those things. It is predominantly machinery, so it won't include field shelters, it won't include livestock. It's predominantly machinery. Now, as far as drainage improvement and fencing, if it's a repair to a fence, or if your accountant thinks that this is quite reasonably repairs to the drainage and repairs to fencing, and you could class it as repairs, repairs are tax deductible, so you could knock them off. You wouldn't need the annual investment allowance. The only areas where you would need the annual investment allowance are for things which aren't deductible expenses. It tends to be bigger projects like sheds, new roads, things like that. The annual investment allowance is predominantly machinery. You can go to HMRC's website, and in fact, if you Google HMRC annual investment allowance, you'll get the guidance pages that come up and explain exactly what is and isn't allowed. And in particular, it explains what things inside a shed might be allowed or not allowed.
Yeah.
Does that help?
Yep.
Okay, so just to recap, we've looked at business structures and responsibilities. Absolutely make sure that you understand what's involved before joining a partnership or becoming a director, because there can be quite big implications. In terms of tax, we've looked at the tax year. So the tax year is the 6th of April to the 5th of April each year. This is different to your financial year. Income tax is paid on all income, so employment income, self-employed income, investment income, etc. Your tax return will consider all the sources of income, then all the relevant deductions and allowances. It will work out what the net tax that you need to pay is. Then it will look at how much you've already paid through PAYE and how much is still to be paid. Machinery purchases can benefit from the annual investment allowance, and this means that the total amount that you pay for the machine is deducted from your taxable profit. That's the total amount before VAT. But buying machinery is not necessarily the best move to reduce your tax bill. There are lots of other things that will give you a better return. It's really important to think about, could I repair a fence? Could I apply some lime? Could I do, there's any number of things which are fully tax deductible that will really help your business, before necessarily thinking about investment in machinery. That said, being canny about when you buy a piece of equipment can be really worthwhile. And this comes back to having the conversation with your accountant before the year end. So if you were planning to spend some money on a particular piece of equipment in the next 12 months, it can be really important to know whether doing it in 6 months' time would be to our advantage or waiting would be more advantageous.
Is it fair to say that a healthy business should be paying some tax, Chloe?
I think many accountants would suggest that with good tax planning, many healthy businesses can avoid paying very much tax at all. It really depends. With really good tax planning, there's not necessarily a need to pay tax. So for instance, if you might have a healthy business, but every year you're replacing a little bit of kit and you're keeping everything fresh and you're using your investment allowances and you're investing in lime and drainage and things like that, you might make very little very little taxable profit, even though you're generating plenty of cash. It's not a bad thing to have to pay tax, but a really good accountant will more than earn their keep by reducing that as much as possible and making sure that you don't need to pay any more than you need to, because HMRC will be very unhappy and very shirty if they think that you have not paid enough tax, but they have no concern at all if you end up paying more tax. Their system is all about making sure that you absolutely pay at least as much as you have to. But there'll be some areas of guidance where they won't necessarily publicise the areas in which you can reduce the amount of tax you have to pay quite as well as they'll publicise the areas about things you do need to pay tax on.
Right.
And then livestock can be valued on a herd basis as a capital asset or on a trading basis, so as a short-term asset. And it's really important your accountant advises which. It will very much depend on your individual circumstances. So the circumstances of, where in the life cycle of your business are you? What are your longer term plans? How quickly are you going to expand the number of stock you've got? Whilst you're expanding the number of stock you're going to have, are you going to be investing in other things? There's quite a complicated number of things to think about when deciding whether it would be advantageous to use a herd basis or not.
Is that something to discuss before setting up, Chloe, or during the setting up process, or when do you have that discussion?
So if you're setting up the business, you need to find yourself an agricultural accountant, and go and see a couple and settle with one that you get on with, that you're pleased with the sort of advice that they're able to give you, and then have a conversation with them before you formally set up, so that you can get the right answers to a herd basis, trading basis, but B, you can think about what the financial year should be. There's a variety of things to think about.
Yeah, and just a question somebody asked, Chloe, is there anywhere where people can get recommendations for agricultural specific accountants? Cool.
I don't think there's a particular register for agricultural accountants. I know that there is a register for specialist agricultural solicitors, but I don't think there's one for accountants. Word of mouth tends to be quite a good idea. Ask your solicitor if they have got any particular recommendations, and ask around, ask your auction market who they would recommend, but go and see a few. If you look on their websites, they're usually quite clear. The ones who are very much focusing on the agriculture sector usually have, it's usually clear from their website that agri is a key sector for them.
It's probably important to find somebody that you can have a good relationship with as well, and work with and communicate with, because there's a lot of it's important that you find somebody that is working for your best interest, not just trying to get the job done for the sake of getting it done. So
yeah, that's right. They're not just filling out paperwork for you. It's not a bookkeeper that you're getting who will just prepare the year-end accounts and fill out a tax return. You're getting tax advice, and the tax advice is really, really important so that you don't end up paying more than you need to.
Yeah.
If you want to get further information about tax generally, if you go onto the Farm Advisory Service website, you can download the Farm Management Handbook free of charge. And if you go to page 505 of the Farm Management Handbook, you'll get the tax sections, and there's information there about income tax, VAT, national insurance. There's a whole lot of summarised information there. If you have specific questions that you want to ask separately, feel free to contact the Farm Advisory Service, and they will forward you on to me if there's something specific you wanted to ask about. Okay, do we have any further questions?
Yeah, so I've got one question here, Chloe. If you're running a very small crofting enterprise, where income and expenses come very close, is it really necessary to employ an accountant, or is it okay to complete and submit your own tax return?
That's a really good question. I think it would depend whether you also have employment income or not, would be my view. If you've got other sources of income that you are paying tax on anyway, then anything that you are able to save from your crofting income, any additional things that an accountant might say, well, you could actually deduct that, or we could use a wee allowance here, or we could plan something. Anything like that will reduce the amount of tax that you have to pay. If you don't have any other taxable income, and your total taxable income is going to be under the personal allowance threshold, so at the moment you can earn £12,500 a year and not pay any tax on that. If your total income is going to be, including your crofting income, is going to be less than the 12,500, then you're not going to be paying tax on it, and it becomes less critical. So I think it really depends in the context of, although the self-employed income might be very, very small, if the overall picture is one of somebody who's paying tax, it may well be worth getting some help from an accountant. And actually, even if you don't necessarily have to be using the biggest accountant, a local accountant will make a really good job of being able to fill out your tax return properly and accurately, and save you a bit of hassle and stress rather than doing it yourself. They're also insured, so that if there's mistakes made or there's a problem, you are covered in that way. Yeah,
that's fine. Here's an interesting one. Here's an interesting question, Chloe. Would a Ford Ranger pickup, I guess for farm use, count towards the annual investment allowance?
Yeah, well, I don't think the type of pickup it is matters, but I think a commercial vehicle would be okay, because it's a commercial vehicle, it's not a car.
Yeah.
So for VAT purposes as well, pickups are far better than cars. So if you buy a double cab pickup, and that's why double cab pickups are so popular. If you buy a double cab pickup, you can reclaim the VAT if it's, it's a business vehicle. But even if you buy a car, even if it's for business use, you can't reclaim the VAT. So that's why double cab pickups have become really important as sort of farm vehicles. I would think that normally cars are excluded from the annual investment allowance, so there's rules depending on what the carbon emissions and things are, but I think pickups are okay. I'll check though and come back to you.
Yeah, yeah.
Okay, any final questions? I see a question here. Somebody's asking if we can send a link to the free download for the farm management handbook. So we'll send round a wee summary by email after tonight, and we'll include the link to the farm management handbook, confirmation of where you can find out that the Ford Ranger pickup would be fine, and any other questions that we've missed.
Yeah.
Okay,
well, thank you very much for joining us tonight, Chloe. I hope everybody found that useful, and keep an eye out for other webinars coming up from the Farm Advisory Service, and hopefully there'll be a lot more content coming out this year.
Any feedback about what other webinars could be on is always welcomed as well. So if you have any particular ideas of what you'd like to hear about next, then do let us know, and wherever possible we will try and accommodate all requests.
Okay.
Thank you very much.
Thank you, Chloe. Thank you.